Two guys work at the same company, same floor, same 401k plan. Greg is 45, Tony is 45. Both of them have about $120,000 saved. Both of them put in $600 a month every month without fail. Neither one of them ever panic sells. Neither one of them ever misses a contribution. For 30 straight years, they do the exact same thing. The only difference between these two men is one number, buried on page 4 of a fund document that neither of them has ever opened. Greg's fund charges almost nothing. Tony's fund charges 1%. 30 years later, Greg has about $1,645,000. Tony has about $1,292,353,000 gone. That's the gap. And here's the part that should stop you cold. Over those 30 years, Tony put in $216,000 of his own money. $600 a month, 360 months. The fee took more than every single dollar Tony ever contributed. It took his entire lifetime of saving, plus another $137,000 on top. Tony never got a bill. Tony never saw a charge. Tony never felt a thing. If you have money sitting in a 401k right now, or an IRA, or a brokerage account, there is a number in there doing this to you at this exact moment, and you almost certainly have never looked at it. So today I'm going to show you 3 things. First, the mechanism. Why a fee that sounds tiny gets bigger every single year you own the fund, even though the percentage never changes. Most people get this completely backwards. Second, the real number. I'm going to show you exactly how much of your retirement a 1% fee takes over 30 years, using math from the Department of Labor that you can go verify yourself in about 4 minutes. And third, I'm going to give you a formula, one line. You'll be able to plug in your own balance and your own fee and get your own dollar figure for your own situation before this video is over. Nobody's telling you what to do here. I'm just going to hand you the math and you decide what it's worth. Let's start with why this thing is so much worse than it sounds. Here's how almost everybody thinks about an expense ratio. You've got $50,000 in a fund. The fund charges 1%, so the fee is $500 a year. And $500 a year for 30 years is $15,000. Annoying, but survivable. You move on with your life. That math is wrong, not slightly wrong, badly wrong, because the fee is not $500 a year. The fee is 1% of whatever your balance happens to be that year. And your balance is supposed to be growing. Watch what actually happens. Year 1, you've got $50,000, so the fee is $500. Year 10, your balance has roughly doubled, so now the fee is $1,000. Year 20, it's doubled again, so now it's $2,000. Year 30, that same 1% is pulling $3,000 or $4,000 out in a single year. The percentage never changed, the dollar amount quadrupled. That's the first half of the trap. Here's the second half, and this is the part that actually does the damage. Every dollar the fee takes out is a dollar that stops compounding forever. That $500 they took in year 1 wasn't just $500. That $500, left alone at 7% for 30 years, would have grown into about $3,800 by the time you retire. So you didn't lose $500, you lost $3,800, and they do it again the next year and the next, 30 times. That's the balance trap. The fee grows as you grow, and every dollar it removes takes 30 years of future growth out with it. Your money compounds. The fee compounds too. It just compounds in the wrong direction. John Bogle, the man who founded Vanguard and basically invented the index fund, had a phrase for this. He called it the tyranny of compounding costs. And when PBS Frontline ran his math for their documentary, The Retirement Gamble, they found that a 2.5% annual cost over a full investing lifetime ate 79% of everything the investor would have earned with no costs at all. 79% of your gains gone to fees. Now hold on to that idea, because it explains the number I'm about to give you. And if you don't understand where that number comes from, you won't trust it enough to act on it. Here's the headline number. This is the payoff. Everything else in this video is support for this one line. A 1% annual fee held for 30 years takes about 25% of your ending balance, 1/4 of everything you built. Not 1%, not 30%, roughly 1/4 of the entire pile, handed over for a number you never agreed to and never see. I call it the missing quarter, and I want to show you the math so you don't have to take my word for it. The U.S. Department of Labor publishes a document called A Look at 401k Plan Fees. It's a free PDF on DOL.gov. And they run this exact scenario. They start with $25,000, 35 years until retirement, 7% average annual return. No additional contributions, just that one lump growing. At 0.5% in fees, that account grows to $227,000. At 1.5% in fees, that same account grows to $163,000. That's a 1 percentage point difference. And the Department of Labor's own words are that it reduces your account balance at retirement by 28%, $64,000, on a starting balance of $25,000 from 1 percentage point. I ran that math myself, and it comes out to $226,563 and $162,845. The government's numbers hold up to the decimal. You can reproduce it on any compound interest calculator in about 4 minutes, and I'd encourage you to, because you shouldn't trust a number just because a guy on YouTube said it. Over 30 years instead of 35, that 28% lands at about 25%. That's the missing quarter. And if you're still contributing monthly like Greg and Tony, your number comes in a bit lower, around 20 to 22%, because the dollars you added in year 28 haven't sat there long enough to get chewed on. I'd rather give you the honest range than the scarier one, 20 to 25% of your retirement. That's the price of 1%. But here's what almost nobody tells you. The expense ratio is usually not the only fee you're paying. It's just the only one you can see. There are 3 layers here, and most people only know about one of them. Layer 1 is the expense ratio. This is the published number. Management, administration, marketing. It's disclosed by law, it's in the fund's fee table, and it's the one we've been talking about. Here's a piece of it that surprises people. Part of your expense ratio may be a thing called a 12B1 fee. That's a marketing and distribution charge, created by an SEC rule back in 1980 that was supposed to be temporary help for funds that were shrinking. 4.5 decades later, it's still here, still capped at 0.75%. So a slice of what you pay every year goes toward the fund company advertising itself to the next guy. You are paying for your own sales pitch. Layer 2 isn't in the expense ratio at all. Trading costs. When a fund manager buys and sells stocks inside the fund, that costs money. Spreads, commissions, market impact. Those costs are not in the expense ratio. They're quietly subtracted from the fund's returns before you ever see a performance number. Index funds barely touch this layer because they hardly trade. Active funds live in it. Layer 3 sits on top of both. If you have a financial advisor charging a percentage of assets, that's typically another 1%, charged separately on the same money. Stack all 3. 1% fund, 1% advisor, plus the trading costs. Now you're at 2% or more. And 2% is not twice as bad as 1%. It's far worse than twice as bad. Take a $100,000 start, $1,000 a month, 40 years, 9% gross. With no fees, that's about $7.8 million. At 2% in combined fees, it's about $4.1 million, $3.7 million, roughly half the portfolio, from 2 percentage points. That's the fee stack. 3 layers, one of them invisible, all charged on the same dollars. So now you know the mechanism and you know the number. Before I give you the formula, I want to cover the 3 mistakes that keep smart people in expensive funds for decades. Because knowing the math doesn't help if you fall into one of these. Mistake number 1, looking at the return instead of the fee. This is the big one. You open your account, you see one fund returned 11% last year and the other returned 9%, and you go with 11%. Feels obvious. Here's the problem. Last year's return does not repeat. The fee does. Morningstar ran a study on this, led by their Director of Manager Research, Russell Kinnell. They sorted every fund into 5 groups by expense ratio and tracked which ones actually survived and beat their peers. In U.S. stock funds, the cheapest 20% succeeded 62% of the time. The most expensive 20% succeeded 20% of the time. The cheap funds were 3 times more likely to win. And it held everywhere they looked. Taxable bond funds, 59% versus 17%. Municipal bonds, 56 versus 16. Their conclusion was blunt. The expense ratio is the single most reliable predictor they have of a fund's future success. More reliable than star ratings, more reliable than past performance. The fee is the one number on the page that is guaranteed to be true next year. Mistake number 2, assuming the expense ratio is the whole cost. We just covered this one. It's the fee stack. If you only check the published number, you may be seeing half your actual cost. Mistake number 3, thinking 1% is small because the annual dollar figure is small. This is the balance trap wearing a disguise. $500 a year does feel small next to a $50,000 balance, but you're not paying $500. You're paying $500 plus the 30 years of growth that $500 would have produced, plus the same thing again next year, forever. Charles Ellis, who used to chair the investment committee at Yale, makes this point better than anyone. He argues that calling it a 1% fee is misleading in the first place, because it's 1% of your assets, not 1% of your return. If the market gives you 6 or 7% after inflation, a 1% fee isn't taking 1% of anything you care about. It's taking 15% or more of what you actually keep. That reframe is the whole video in one sentence. It's not a 1% fee, it's a 15% tax on your gains. Let me show you what this looks like at 3 different balances, because the number that matters is yours, not Greg's and not Tony's. Same setup for all three. 30 years, 7% gross, no new contributions, just the money you already have. One fund charges basically zero, the other charges 1%. $50,000 invested today. At 7%, you end with about $380,000. At 6% after the fee, about $287,000. The fee took $93,000, $150,000. 7% gets you to about $1,142,000. 6%, about $862,000. The fee took $280,000, $300,000. 7% gets you to about $2.28 million. 6%, about $1.72 million. The fee took $560,000. Look at the pattern. It's the same 25% every time. The fee doesn't care how much you have. It takes the same quarter of your future either way, which means the more you've managed to save, the more this costs you in raw dollars. If you've done well, you have more at stake, not less. Here's your formula. This is the thing I want you to walk away owning. Take your expense ratio, multiply it by 25. That's the percentage of your 30-year balance the fee takes. Then multiply that percentage by whatever you project your balance to be. That's your fee tax number in dollars. Let's run it. 1% times 25 is 25%. On a projected balance of $1 million, that's a fee tax number of $250,000. 0.5% times 25 is 12.5%. On $1 million, that's $125,000. 0.03%, which is what a lot of broad index ETFs charge now, times 25 is about 0.75%. On $1 million, that's $7,500. 250,000 versus 7,500. Same $1 million portfolio, same market. The only difference is a number on page 4. Two things about this formula so nobody catches me in the comments. It assumes 30 years and a 7% gross return, so if your timeline is shorter, scale it down. And it starts to run a little hot above 1.5%, so treat it as a solid estimate in the range most people actually live in, which is 0 to 1.5. If you'd rather not do this by hand, I built a free Dividend Snowball calculator that runs this kind of compounding math on your own numbers. It's linked in the description. Plug your balance in, plug your fee in, see your own fee tax number. The formula only works if you know your expense ratio. So here's where it lives. If it's a 401k, log in, find your fund list, and look for a column called expense ratio, or gross expense ratio, or sometimes just net expense. It may be shown in basis points, where 100 basis points equals 1%. If it's an IRA or a brokerage account, pull up the fund's ticker on your broker's site. It's on the main fund page near the top. For context on what you find, the Investment Company Institute publishes the industry averages every year. As of their 2025 data, the average equity mutual fund charges about 0.40%, weighted by assets. The average index equity ETF charges about 0.14%. So if your number starts with a 1, you're paying somewhere between 3 and 7 times the current market rate. That doesn't automatically mean it's wrong. Some plans have limited menus. Some people genuinely value what an advisor does. That's your call, and I'm not going to make it for you, but you should at least know what it costs. Right now, most people don't. Let's put it all back together. The balance trap. The fee is charged on your growing balance, so the dollar amount climbs every year even though the percentage never moves. And every dollar it takes stops compounding permanently. The missing quarter. 1% over 30 years takes roughly 25% of your ending balance, or 20 to 22% if you're still contributing. The fee stack. 3 layers. The published expense ratio, the trading costs that aren't in it, and the advisor fee that may sit on top. Only one of the 3 is easy to see. The fee tax number, your expense ratio, times 25, times your projected balance. That's your dollar figure. Now go pull up your account and find your expense ratio. Then drop that number in the comments. I read them, and I want to see what people are actually being charged out there, because the spread between what's available and what's sitting in people's 401ks is wider than the industry likes to admit. And if fixing this is what you want to do next, watch the best ETFs to live off dividends in America. That one goes through the specific tickers and what each charges so you can see the alternatives side by side. Which brings us back to Greg and Tony. Same company, same salary, same $600 a month for 30 years, same discipline. Neither of them made a mistake anyone would recognize as a mistake. Greg just happened to be in a fund that charged him almost nothing. Tony happened to be in one that charged 1%. Nobody handed Tony a bill. Nobody warned him. It just quietly took $353,000 out of his retirement, one invisible slice at a time, for 30 years. The only thing that separated them was a number on page 4 that one of them bothered to look up. Go look up yours.